Hi guys! Enjoy John's analysis.
This morning, oil crashed 6% and Bitcoin crossed $82,000. And most analysts are reading this event completely backwards. Because at the exact moment Bitcoin was climbing toward that number, the single on-chain indicator that called every major crash in this cycle was firing a warning signal that almost nobody in this space is reading. And if you do not understand what that signal means before the end of this video, you are going to misread the next move in this market. And that mistake is going to be expensive. Here is the core contradiction this video is going to resolve. A peace deal between the United States and Iran was reported this morning by Axios, citing 2 U.S. officials and 2 additional sources briefed on the matter. Oil crashed 6%. Nasdaq futures jumped more than 1%. Bitcoin crossed $82,000 for the first time since January. Every surface signal says this is a clean, legitimate, macro-driven rally in a risk asset that was unfairly suppressed by a geopolitical conflict that is now moving toward resolution. And yet, underneath that surface, the data that has correctly identified the fragility of every major Bitcoin rally since October of 2025 is sending the opposite signal. The market moved up. But the foundation of the move has not been confirmed by the metrics that matter most. My name is John, and here at Engineered Markets, we do not do price analysis. We do market engineering, which means before any opinion comes out of this channel, the data comes first. Every single claim you hear in this video is sourced, verified, and traceable to a primary document. Axios, CoinDesk, CryptoQuant, Bloomberg, The Block, Be in Crypto. No anonymous sources, no speculation dressed up as analysis, no price targets. That is the only standard we operate by, and it is the only standard that gives you an actual edge in a market full of people who are very confident and very often wrong. Today's data tells a story with 2 completely different faces, and the gap between those 2 faces is where the real trading decision lives. The first face is what you're seeing in every headline right now. Peace, relief, Bitcoin going up, oil going down, risk assets rallying globally. That face is real. The event behind it is real. The price move is real. The geopolitical logic is sound. The second face is what the on-chain data and the derivatives positioning data are showing underneath that surface movement. And the 2 faces cannot both be simultaneously correct without something eventually giving way. In this video, you are going to understand, first, exactly what happened with the US-Iran Memorandum of Understanding today and why it moved markets in under 30 minutes. Second, why the Bitcoin rally you're watching right now was built on a foundation that the data itself, not opinion, the data, describes as structurally fragile. Third, what the stablecoin reserve data and perpetual futures positioning are signaling that every mainstream analyst is either ignoring or does not know how to read correctly. Fourth, how the American Strategic Bitcoin Reserve announcement and BlackRock's 7% supply concentration permanently change the structural equation of this market, regardless of what happens with the Iran deal in the next 30 days. And fifth, 3 mathematical scenarios for what comes next, with the precise on-chain and macro indicators that will tell you which scenario is materializing before the price action confirms it. Stay until the end of this video, because the third scenario is the one the market is least pricing right now. And historically, the scenarios the market is least pricing are the ones that produce the largest and fastest moves when they activate. At 9:26 in the morning today, May 6th, 2026, Axios published a report based on 2 United States officials and 2 additional sources briefed directly on the matter. The White House believes it is getting close to an agreement with Iran on a 1-page memorandum of understanding, a document designed to end the war and establish a framework for more detailed nuclear negotiations to follow. The report landed on trading desks across London, New York, and Singapore within minutes, and the reaction in every major asset class was immediate, coordinated, and massive. To understand how a single Axios report can move Bitcoin 6% in 30 minutes, you need to understand the chain of causation that links a diplomatic document in Washington to the price of a digital asset on a decentralized network. This chain has 3 links. The first link is oil, the second link is the Federal Reserve. The third link is the opportunity cost of holding Bitcoin relative to cash. Each link is measurable and documented. None of them requires speculation to explain. The 1-page document, technically a 14-point memorandum of understanding, was being negotiated between Trump's envoys, Steve Witkoff and Jared Kushner, and several Iranian officials, both directly and through intermediaries, including Pakistani mediators, who had been facilitating back-channel communication since March. The negotiations had been the most consequential diplomatic process of the year, precisely because of what was at stake beyond the immediate military conflict. In its described form, the memorandum would declare an end to the active war in the region, and open a 30-day window for negotiations toward a comprehensive agreement covering 3 interconnected issues: the reopening of the Strait of Hormuz to commercial shipping, limitations on Iran's nuclear enrichment program, and the lifting of American sanctions tied to the conflict. Each of these three issues connects directly to global financial markets in ways that most crypto analysts have never modeled with precision. The terms described in the Axios report represent the furthest the two sides have come toward agreement since the conflict began. The moratorium on uranium enrichment, which Iran had previously called a red line it would not cross, appears in the document as a commitments with a duration being actively negotiated between 12 and 15 years. The lifting of sanctions and the release of billions in frozen Iranian funds represent the economic incentive that Iran's government needs to sell any agreement domestically. And the gradual reopening of the Strait of Hormuz during the 30-day negotiation period, rather than waiting for a comprehensive agreement to be finalized, is the provision that matters most for oil prices and therefore for Bitcoin's monetary policy environment. The strait would be progressively reopened to neutral commercial vessels during the negotiation window, with the U.S. naval blockade being incrementally reduced in parallel. If the talks collapse, the U.S. retains the right to restore the blockade and resume military action. The market reaction to the Axios report was immediate and precise in its directionality. Bitcoin crossed $82,000 during the European morning of this Wednesday, the first time this asset touched that level since January of 2026, representing a recovery of roughly 30% from the April lows near $62,000. Nasdaq futures rose more than 1% in the 30 minutes following the report. WTI crude oil futures fell approximately 6% to $95.28 per barrel, the largest single-day oil move in weeks. The broader risk asset complex, equities, emerging market currencies, high-yield bonds, all moved in the same direction simultaneously. This kind of synchronized cross-asset movement only happens when a single macro event changes the underlying assumption about the direction of monetary policy, energy costs, and geopolitical risk premium all at once. And those three variables, monetary policy direction, energy costs, and geopolitical risk premium, are precisely the three variables that have been suppressing Bitcoin's price since the conflict began in February. But here is where the engineering begins and where most analysis ends. If you are looking only at those headline numbers, Bitcoin up, oil down, Nasdaq up, you are looking at the packaging of today's event. You are not looking at the structure underneath the packaging. Because in the exact same window of time that Bitcoin was climbing toward $82,000, an on-chain metric that functions as the fuel gauge of any sustainable rally was pointing sharply in the wrong direction. That metric told a completely different story about whether the demand driving this price move is the kind of demand that holds a level for weeks and months, or the kind of demand that evaporates the moment the next headline changes. Understanding the difference between those two types of demand is not a minor technical distinction. It is the difference between a trading decision made with genuine information and a trading decision made on emotion dressed up as analysis. That difference, compounded across multiple decisions over a market cycle, is the difference between accounts that grow and accounts that do not. If you are looking only at those headline numbers, Bitcoin up, oil down, Nasdaq up, you are looking at the packaging of today's event. You're not looking at the structure underneath the packaging. Because in the exact same window of time that Bitcoin was climbing toward $82,000, an on-chain metric that functions as the fuel gauge of any sustainable rally was pointing sharply in the wrong direction. That metric told a completely different story about whether the demand driving this price move is the kind of demand that holds a level for weeks and months, or the kind of demand that evaporates the moment the next headline changes. Understanding the difference between those two types of demand is not a minor technical distinction. It is the difference between a trading decision made with genuine information and a trading decision made on emotion dressed up as analysis. That difference, compounded across multiple decisions over a market cycle, is the difference between accounts that grow and accounts that do not. Time, 5 minutes to 10 minutes. To understand why oil and Bitcoin are mathematically connected in this specific conflict, and why they are connected in a way that is fundamentally different from previous geopolitical events, you need to understand the structural role of the Strait of Hormuz in the global financial architecture. This is not a geography lesson. This is a monetary policy lesson delivered through a map. The Strait of Hormuz is the most important single choke point on the planet for the global energy market. Approximately 20% of all global oil transit passes through that narrow strip of water between Iran and the Arabian Peninsula, roughly 17 million barrels per day during normal operations. Japan, South Korea, China, India, and most of Southeast Asia receive the majority of their oil supply through that strait. When Iran restricted transit in February of 2026, the ripple effect was not a regional disruption. It was a global inflation event. Here is the precise mathematical mechanism that connects oil prices to Bitcoin prices through monetary policy. And it is a mechanism that almost no crypto analyst discusses with specificity. When the Strait of Hormuz was effectively closed by Iranian restrictions and the subsequent American naval blockade that followed, the price of oil spiked from a pre-war range of approximately $80 to $90 per barrel to over $115 per barrel at its peak. That spike fed directly into headline inflation figures across every major economy, because energy costs are embedded in the production and transportation cost of virtually every physical good on the planet. When inflation rises unexpectedly because of an oil shock, central banks face an immediate dilemma. They cannot cut interest rates into rising inflation without risking a loss of credibility that took decades to build. The Federal Reserve, which had been signaling a cautious path toward rate normalization through late 2025, found itself trapped. Rate cuts became politically and economically impossible. Now here is why that matters for Bitcoin specifically, and why the engineering of this connection is so precise. Bitcoin is a non-yielding asset. It pays no dividend, no coupon, no interest. In an environment where interest rates are high, where a 3-month Treasury bill pays 3.5% to 3.75% annually, the opportunity cost of holding Bitcoin instead of holding cash or bonds is real and measurable. Every basis point that the Federal Reserve cannot cut because of oil-driven inflation is a basis point of opportunity cost headwind for Bitcoin. The war in the Strait of Hormuz was not just a military event or a geopolitical news story. It was a mechanism for suppressing the price of Bitcoin through the monetary policy transmission channel. And the peace deal today is the direct reversal of that mechanism. Professor Zheng Xueqin, who has provided the geopolitical framework for our analysis on this channel since the beginning of the conflict, described this dynamic in terms that the mainstream financial media has not caught up to yet. The war in the Strait was not fundamentally about oil. It was about who controlled the conditions of global liquidity. Because controlling the price of oil meant controlling the ability of the world's most important central bank to ease financial conditions. When the United States launched Operation Freedom in April to escort commercial vessels through the Strait following Iran's 14-point peace proposal, the message delivered to global markets was not a military message. It was a monetary policy message. American power would be used to prevent Iran from holding the Federal Reserve's rate policy hostage through energy prices. The historical precedent for how the market responds to these geopolitical easing events is documented and measurable. When the first 2-week ceasefire was announced on April 7th of this year, the oil market fell 13% within hours, and Bitcoin rose 6.7%, reaching $72,379 in the immediate aftermath. That was a temporary pause, not a structural resolution. The market gave back much of that move when the Islamabad negotiations collapsed after 21 hours of talks without agreement, and Bitcoin fell from $73,000 back to $70,000 in a matter of hours. What markets are attempting to price today is categorically larger in scale than either of those previous events, because the Axios report describes not a ceasefire, but a framework for ending the war entirely, including nuclear concessions from Iran that Tehran had previously refused to consider. The pre-war price of Bitcoin in the second week of January of 2026 was in the range of $97,000. The all-time high, reached in October of 2025, was $126,198. The geopolitical discount applied to Bitcoin's price over the course of the conflict. The difference between where Bitcoin was before the war began and where it trades today represents the market's pricing of energy inflation risk, Federal Reserve entrapment, and global uncertainty premium. If that discount reverses through a genuine peace resolution, the mathematical path from 82,000 back toward pre-war levels becomes the base case, not the optimistic scenario. But the bear case must be stated clearly and honestly before we move forward. The Axios report itself is unambiguous. Nothing has been agreed. The document contains the precise language that the memorandum's terms would be contingent on a final agreement being reached, leaving open the possibility of renewed war or an extended limbo in which the hot war has stopped, but nothing is truly resolved. Multiple market participants cited by CoinDesk this morning are openly questioning the durability of any breakthrough, particularly around Iran's nuclear concessions, which represent the single hardest point in any Iran negotiation since 2015. The gap between a one-page memorandum of understanding and a ratified binding nuclear agreement is the same gap that has swallowed every Iran deal attempt for the past decade. The market is pricing hope today. The data will tell us whether that hope has a foundation. Now we arrive at the part of this analysis that separates the engineered markets framework from everything else you will read about today's move. And for this, we need to talk about a metric that most Bitcoin channels never mention, a metric that most retail traders have never heard of, and a metric that has a near-perfect track record of distinguishing sustainable rallies from speculative ones. That metric is stablecoin reserves on centralized exchanges. Stablecoins are the primary liquidity layer of the entire cryptocurrency market. They are dollar-pegged digital currencies. Tether's USDT, Circle's USDC, Binance's BUSD. that traders and institutions use as the functional equivalent of cash inside the crypto ecosystem. When a new buyer wants to purchase Bitcoin, the typical sequence is they wire dollars from a bank account to an exchange. Those dollars are converted into stablecoins on the exchange platform, and then those stablecoins are used to buy Bitcoin. The stablecoin is the intermediate step, the dry powder sitting on the exchange, ready to be deployed the moment the buyer decides to act. This means that the aggregate balance of stablecoins held on centralized exchanges functions as a real-time measure of latent demand, of capital that is positioned inside the crypto ecosystem and ready to be converted into Bitcoin or other assets. When that balance is rising, it means new capital is arriving. When that balance is falling, it means capital is leaving. And the question becomes whether it is rotating into Bitcoin from stablecoins or leaving the ecosystem entirely. This distinction matters enormously for understanding the sustainability of a rally. In a healthy, structurally sound Bitcoin bull market, the pattern of stablecoin reserves and price action follows a specific sequence. As Bitcoin's price rises and new buyers want exposure, they enter the ecosystem by converting fiat into stablecoins. This creates a simultaneous increase in both stablecoin reserves and Bitcoin price because new capital is arriving to fund new purchases. The expanding stablecoin reserve is the pipeline. The rising price is the output. When the pipeline is growing, you know the rally is being fed by genuine, fresh demand. When the pipeline is shrinking while the price is rising, one of two things is happening. Either existing holders are converting their stablecoins directly into Bitcoin at an accelerating pace, which is temporarily bullish but unsustainable, or, and this is the more dangerous reading, capital is leaving the ecosystem entirely through the stablecoin exit door, and the price is rising only because sellers have temporarily disappeared, not because buyers have genuinely arrived. On May 4th, 2026, just 2 days ago, technical analyst Ali Martinez, who publishes as Ali Charts with over 165,000 followers on social media, flagged a data point that should have dominated the narrative of every finance channel covering Bitcoin. Stablecoin reserves on exchanges dropped 5.18% in the preceding 7 days, falling from $70.37 billion to approximately $66.37 billion. That is a contraction of $4 billion in a single week. $4 billion of potential buying power that left centralized exchanges precisely during the window when Bitcoin was testing and then breaking above the $80,000 level for the first time since January. The timing of that exit is not ambiguous. Capital was leaving the crypto ecosystem at the same moment the price was climbing. That is the structural contradiction at the heart of this rally. Ali Martinez was unambiguous in his interpretation of this data. He wrote, typically, when Bitcoin price and stablecoin reserves fall simultaneously, it signals a deleveraging event or capital flight. The current push toward $80,000 remains structurally fragile. The Street Crypto, reporting on the same data on May 5th, cited another analyst making the same structural point with equal precision. A market cannot sustain a macro breakout without deep liquidity on the sidelines. Until we see stablecoin reserves begin to replenish, the current push toward $80,000 remains structurally fragile. 2 independent analysts, 2 independent data sources, one identical conclusion. The foundation of this rally is thinner than the price suggests. Now I'm going to show you the second layer of data that no mainstream analyst is integrating into this picture. And when you see these 2 data sets together, you will understand exactly why the engineered markets framework exists. On April 30th, 2026, CryptoQuant published a research note authored by its head of research, Julio Moreno. The finding was stark, specific, and important enough that it should have stopped every Bitcoin bull narrative in its tracks. The April rally, the 12.7% move that carried Bitcoin from $66,000 to $79,000 and made it Bitcoin's best month since April of 2025, was driven exclusively by growth in perpetual futures demand. Spot demand, as measured by CryptoQuant's apparent demand metric, which tracks 30-day changes in on-chain coin accumulation, did not turn positive a single time during the entire month of April, not once. The price went up 12.7% in April, and the underlying spot market demand for the asset was negative the entire time. Moreno was explicit in his interpretation. This divergence, rising futures demand alongside contracting spot demand, suggests that price appreciation is driven by leverage rather than fresh coin accumulation. That sentence is worth reading twice because it describes the structure of the April rally with clinical precision. A leveraged rally is a rally where the price moves up because traders are borrowing capital to buy derivatives, contracts that track the price of Bitcoin, not because they are buying actual Bitcoin in the spot market. The derivatives price moves up, which makes the spot price follow, which creates the appearance of a bull market. But there is no actual accumulation of Bitcoin happening behind that price move. The coins are not being removed from exchanges and put into cold storage by long-term holders. The on-chain footprint of genuine demand, the kind that sustains a rally through multiple months and multiple retests, is absent. The historical context for this type of divergence is well documented and sobering. CryptoQuant's research identified that similar patterns, rising futures demand combined with negative apparent spot demand, were present at the beginning of the 2022 bear market, when Bitcoin entered a prolonged and punishing correction that eventually took the price from $67,000 to $15,500. IB Times confirmed this historical parallel in its coverage of the CryptoQuant data, noting that rallies built on leverage typically resolve through correction once futures positioning unwinds. The correction does not always happen immediately. Leveraged rallies can continue for weeks or even months before the unwind occurs. But when it does occur, the lack of genuine spot accumulation underneath means there is no natural floor of long-term holder conviction to arrest the decline. Bloomberg adds another dimension to this picture that makes the current market structure even more specific in its historical precedent. In mid-April, Bloomberg reported that funding rates on Bitcoin perpetual futures, the periodic payment exchange between long and short position holders, which measures whether the leveraged market is predominantly bullish or bearish, had been negative for 46 consecutive days, 46 straight days. That is the longest sustained negative funding streak recorded since November of 2022, during the collapse of the FTX exchange, when Bitcoin was trading below $16,000. FAMX analyzed the two previous instances in Bitcoin perpetual futures history where negative funding persisted for 40 or more consecutive days. Both of those instances resolved with violent short squeezes, rapid forced buying of Bitcoin by short sellers whose positions were being liquidated, that produced sharp upward price movements within weeks of the streak ending. The mechanics of a short squeeze in perpetual futures markets are specific and important to understand. When funding rates are negative, it means the leveraged market is predominantly short. Traders are borrowing money to bet that Bitcoin's price will fall. As more shorts pile in at similar price levels, the aggregate liquidation price of all those short positions, the level at which their exchanges will forcibly close them, clusters above the current price. If the spot price rises through that cluster for any reason, the forced buybacks from liquidated shorts create additional buying pressure, which pushes the price higher, which triggers more short liquidations above, which creates more forced buying. This self-reinforcing cascade is called a short squeeze, and it can move a price 20 or 30% in hours without any meaningful increase in genuine long-term holder demand. That is precisely what happened in April. The 46 days of accumulated short positioning created the fuel for the squeeze. The ceasefire news and ETF inflow data provided the initial spark. The price moved 12.7% in a month, and the apparent demand, the real on-chain accumulation signal, never confirmed it. What all of this means for today's move is this. The Iran peace deal news that broke this morning arrived like a second match thrown into a room that was already full of fuel. The perpetual futures market still had significant short exposure built up from the positioning of the past several weeks. When the Axios report hit, the price moved up sharply, triggering another round of forced short covering and derivatives-driven momentum buying. The price crossed $82,000, and almost none of that move was driven by someone in Sao Paulo or London or Tokyo wiring money to an exchange, buying stablecoins, and purchasing spot Bitcoin because they believe the peace deal is real and durable. That is the structural reality of where this rally stands as of this morning. The question the next 48 hours will answer is whether today's geopolitical catalyst is large enough and credible enough to actually bring that real spot demand through the door. Time, 17 minutes to 18 minutes. Before we get into the three scenarios that are going to determine whether this rally holds or collapses, one quick pause. If you are watching this video from Sao Paulo, where it is 25 degrees today, from New York, where it is 16 degrees, from London, where it is 13 degrees and raining, from Lagos, where it is 32 degrees, or from Singapore, where it is 31 degrees, wherever you are watching this right now, if this kind of data-driven framework is what you have been looking for in a Bitcoin analysis channel, the subscribe button is right below this video. This channel publishes every time a market-moving signal appears in the on-chain data. We do not publish on a schedule. We publish when the data says something worth saying. If you activate the bell notification, you will be in the room when that happens, regardless of time zone. And if you are already a subscriber who has been with this channel through the conflict, through the volatility, through every analytical framework we have built together over the past months, I see the diamond. That is for you. Now let us get into the part of this analysis that changes everything we just discussed about short-term fragility. Because the next section is where the long-term structural equation becomes something that no short-term data point can override on its own. There's a parallel narrative developing on top of everything we have discussed so far. And this narrative is what potentially transforms a structurally fragile short-term rally into the beginning of a permanent structural shift in how Bitcoin is priced. To understand this narrative, We need to go back 10 days to Las Vegas on April 28th of 2026 during the Bitcoin 2026 conference held at the Venetian Resort. Patrick Witt, the executive director of the President's Council of Advisors for Digital Assets at the White House, stepped onto a conference stage and said something to the assembled audience that no senior White House official had said with that level of concreteness in any public forum before. In the next few weeks, we will be making a big announcement. He then elaborated, I think we have a bit of a breakthrough. Witt confirmed that his team has spent months working through the legal framework and operational interpretations required to protect the Bitcoin sitting on the United States government's balance sheet, and that the executive branch believes it can take a significant step forward without waiting for congressional legislation to pass. The federal government of the United States currently holds approximately 328,372 Bitcoin. At prices around $82,000, that position is worth approximately $26.9 billion. It makes the United States government the largest known sovereign holder of Bitcoin in the world by a significant margin. And it represents approximately 1.56% of Bitcoin's entire circulating supply in a single government's possession. How did the United States accumulate this position? Almost entirely through criminal and civil asset forfeitures, Bitcoin seized from drug traffickers, ransomware operators, fraudsters, and other criminal enterprises over the past decade. The most famous single seizure was the Silk Road case, which produced approximately 69,000 Bitcoin confiscated from Ross Ulbricht and subsequent wallets. Multiple additional seizures from cases, including the Bitfinex hack recovery and various darknet market takedowns, added to the total. This was not a strategic investment. The United States government became the world's largest sovereign Bitcoin holder largely by accident, through the normal operation of its criminal justice system. But Patrick Witt's announcement suggests that the Trump administration intends to convert that accidental position into a deliberate strategic posture. The legislative vehicle for formalizing that posture is the American Reserves Modernization Act, ARMA, which was introduced at the same Las Vegas conference by Representative Nick Begich, who announced the renaming of the previous Bitcoin Act to reflect what he described as a broader mandate. The ARMA bill builds on the executive order that President Trump signed in March of 2025, establishing the strategic Bitcoin reserve, while going significantly further. Most importantly, the ARMA bill proposes that the United States government actively purchase 200,000 Bitcoin per year for 5 consecutive years through budget-neutral strategies, defined as mechanisms that do not require direct congressional appropriation of new spending, such as revaluing gold certificates or other creative treasury mechanisms. 1 million Bitcoin total, accumulated over 5 years, added to the 328,000 already held. Now let us do the mathematics that almost nobody in the financial media is doing, because this arithmetic changes the entire supply-demand picture of Bitcoin at a structural level. After the April 2024 halving, the Bitcoin network produces approximately 925 new Bitcoin per day. That is the total new supply entering circulation every single day across the entire planet. If the ARMA bill passes and the US government begins purchasing 200,000 Bitcoin per year, that translates to approximately 548 Bitcoin per day, being absorbed by a single buyer, the United States Treasury. 548 out of 925. That is 59.2% of all new daily supply being absorbed by one government. And that calculation does not include any demand from BlackRock, Fidelity, Morgan Stanley, or any other institutional buyer. It does not include demand from retail investors. It does not include demand from other sovereign governments. It is just the US government alone, absorbing 59% of every Bitcoin created every day. Professor Zhang Shuiqin has framed the geopolitical implication of American sovereign Bitcoin accumulation in terms that Western financial analysts consistently underestimate or dismiss entirely. When the most powerful country in the world institutionalizes Bitcoin as a strategic reserve asset at the federal level, the signal sent to every other nation's finance ministry and central bank is not optional. It is mandatory to engage with. The question for every other government becomes binary. Do we want to be in a world where the United States holds Bitcoin and we do not? Or do we want to build our own position before the competition for a fixed supply of 21 million coins becomes explicitly sovereign in nature? El Salvador recognized this dynamic years ago and built its position early. Texas created a state-level strategic Bitcoin reserve in June of 2025. New Hampshire passed similar legislation in May of 2025. The sovereign cascade has already begun at the state level in the United States. ARMA would move it to the federal level and signal every allied government simultaneously. But the bear case of this narrative is not hypothetical. It is documented in the timeline of the reserve itself. The March 2025 executive order that established the strategic Bitcoin reserve set 2 deadlines. Agencies had 30 days to report their Bitcoin holdings to the Treasury, and the Treasury Secretary had 60 days to propose legislation. Both deadlines passed with no reported action and no public update from Treasury. Patrick Witt told Yahoo Finance in February of 2026, 3 months before the Las Vegas conference, that Bitcoin purchases for the reserve would hinge on congressional action. The gap between Witt's optimistic big announcement in the next few weeks language and the documented pattern of missed deadlines and stalled legislation is a gap the market needs to price honestly. An executive order without a congressional mandate can be reversed by the next administration. A buy order that never appears on the spot market does not tighten supply, no matter how many conferences it is announced at. Until Bitcoin moves from the U.S. Marshal Service wallet into a Treasury custodial account, and until buy orders from the U.S. government appear in the on-chain data, the sovereign reserve narrative remains a powerful forward-looking variable, not a present catalyst. There is a specific number in today's analysis that should be the lead paragraph of every serious financial publication covering Bitcoin, and it is almost entirely absent from mainstream coverage: BlackRock's iShares. Bitcoin Trust, the IBIT, currently holds approximately 809,870 Bitcoin. That figure represents 62% of all Bitcoin held across every U.S.-listed spot Bitcoin ETF combined. And it represents nearly 7% of all the Bitcoin that will ever exist in the history of the universe. To understand why 7% is a categorically different kind of number than 6% or 5%, you need to understand the arithmetic of Bitcoin's fixed supply and the distribution of that supply across different holder categories. The protocol established by Satoshi Nakamoto sets an absolute cap of 21 million Bitcoin, a number that cannot be changed without the agreement of effectively the entire network, which has never happened and shows no signs of becoming politically feasible. Of the 21 million, approximately 19,500,000 Bitcoin have been mined and entered circulation since the Genesis block was mined in January of 2009. Of those 19,500,000, academic research and on-chain analysis from firms including Chainalysis estimate that between 3 and 4 million Bitcoin are permanently inaccessible. Coins held in wallets, where the private keys were lost, destroyed, or forgotten, representing early mining rewards from the first years of Bitcoin's existence, when the asset had near zero monetary value, and holders had no reason to protect their keys carefully. Satoshi Nakamoto's own wallets, holding approximately 1 million Bitcoin that have not moved since the earliest days of the network, are widely included in this category. This means the genuinely circulating, economically active supply of Bitcoin, coins that could conceivably reach the market in response to the right price, is somewhere between 15 and 16 million Bitcoin. BlackRock's 809,000 coins represent approximately 5 to 5.5% of that genuinely circulating supply, not the headline 7% of nominal supply. Either way, the concentration is historically unprecedented for any single institutional actor in any finite supply asset class. John and Grace, our analytical team here at Engineered Markets, modeled this concentration against the gold ETF precedent specifically because gold is the closest analog in terms of being a finite, non-yielding store of value asset with long institutional history. When the first gold ETF, the SPDR Gold Shares, ticker GLD, launched in November of 2004, the initial rate of institutional accumulation was significant but measured. In the first 2 years of the ETF's operation, institutional gold holdings via exchange-traded products grew from approximately 0 to roughly 2% of total above-ground gold supply. That 2% threshold was reached in 2006. The price of gold from the ETF launch in November 2004 to the end of 2011, a period of 7 years, rose from approximately $450 per troy ounce to approximately $1,900. That is a 420% increase over 7 years, driven substantially by the structural demand represented by institutional accumulation through ETF products. Bitcoin's equivalent metric today stands at 7% of nominal supply in a single product, BlackRock's IBIT alone, before the equivalent market maturation timeline has reached its midpoint. The April inflow data for IBIT is specific and important. BlackRock's Bitcoin Trust accumulated $2.14 billion in net monthly inflows during April of 2026, the strongest month for the product since October of 2025. On April 24th alone, IBIT recorded over $22 million in single-day net inflows. Across the broader ETF sector, April produced the 8th consecutive inflow session before the end of the month, with over $2.4 billion in net new capital entering Bitcoin ETFs since early April, a monthly figure that exceeded March's previous record of $1.2 billion. The broader U.S. spot Bitcoin ETF complex absorbed an estimated 19,000 Bitcoin in the final 5 days of April alone, removing that supply from available exchange balances at a rate that compressed the already thin order books on major exchanges. Total net assets held across all U.S. spot Bitcoin ETFs have now crossed $100 billion, a threshold that places this product category among the most successful ETF launches in the entire history of exchange-traded products globally. The cumulative net inflows since the January 2024 launch of the first spot Bitcoin ETFs have reached $58 billion. For context, gold ETFs took approximately 5 years to accumulate their first $50 billion in net inflows after the 2004 launch. Bitcoin ETFs did it in approximately 27 months. The pace of institutional absorption of Bitcoin supply via regulated products has no historical precedent in any comparable asset class. The bear case of this concentration dynamic is real and deserves explicit acknowledgement. A market where a single manager controls 7% of nominal supply and 62% of institutional product supply is a market with asymmetric fragility on the downside. If BlackRock's IBIT experiences a significant redemption wave, triggered by a macro regime shift, a regulatory change, a major institutional scandal, or simply a sustained period of poor price performance that causes institutional allocators to reduce their cryptocurrency weighting, the volume of Bitcoin that must be sold to honor those redemptions creates a supply event that the remainder of the spot market cannot absorb without substantial price impact. The same concentration that acts as a structural floor on the upside acts as a structural amplifier of downside moves if it reverses. This is not a speculative risk. It is the arithmetic of concentrated ownership in a thinly traded asset applied to a high-stakes market environment. We have arrived at the moment where engineering analysis must be translated into actionable decision structure. This channel will not give price targets. Engineered Markets has never given a price target and will never give one, because precise point predictions in probabilistic systems produce false confidence that the data does not support. What we will give you are 3 distinct scenarios, each with a specific structural logic, each with precise and observable indicators that you can monitor in real time to know which scenario is unfolding before the price movement confirms it. The earlier you identify which scenario is materializing, the more time you have to position accordingly. Scenario 1. The deal holds and spot demand confirms. This is the scenario where the one-page memorandum of understanding between the United States and Iran successfully converts into a formal agreement within the 30-day negotiation window that the MOU establishes. Under this scenario, the Strait of Hormuz is progressively reopened to commercial traffic over the course of that 30-day period. The price of WTI crude oil, which is currently near $95.28, falls toward the $70 to $80 per barrel range, as the market prices in restored supply from Persian Gulf producers and the elimination of the war risk premium that has been embedded in energy prices since February. With energy inflation retreating, the Federal Reserve recovers the political and economic space to resume its rate-cutting cycle, potentially delivering 1 or 2 rate reductions before the end of 2026. Lower interest rates reduce the opportunity cost of holding Bitcoin, making it more attractive relative to cash and short-term bonds for institutional portfolio managers who are making allocation decisions on behalf of pension funds, endowments, and sovereign wealth funds. Spot capital begins flowing back into the crypto ecosystem. Stablecoin reserves on exchanges, currently at $66.37 billion, stop falling and begin growing, replenishing the dry powder that was depleted during the speculative phase of the April and early May rally. CryptoQuant's apparent demand metric, which measures real on-chain accumulation, turns positive for the first time since October of 2025. The price of Bitcoin, now at $82,000 on the strength of short covering and derivatives momentum, finds genuine spot buying underneath it that converts the speculative rally into a structural one. The specific indicators that confirm scenario 1 are 3, and you can monitor all 3 in real time through public data sources. First, stablecoin reserves on centralized exchanges returning to growth over any rolling 7-day window, moving back toward $70 billion and above. This data is available through Glassnode, CryptoQuant, and Nansen with minimal delay. Second, CryptoQuant's apparent demand metric turning positive and sustaining that positive reading for at least 3 consecutive days. Not a single day spike, but a genuine directional reversal that reflects sustained on-chain accumulation. Third, weekly net inflows into U.S. spot Bitcoin ETFs remaining above $500 million for at least 2 consecutive weeks, confirming that institutional buyers are adding exposure at these price levels rather than reducing it. If all 3 of these indicators turn positive simultaneously and sustain that reading for more than a week, the structural argument for this rally's durability becomes mathematically compelling. Scenario 2. The deal collapses and the leverage unwinds. This is the scenario where the 30-day negotiation window opened by the Memorandum of Understanding fails to produce a formal agreement, repeating the pattern of the Islamabad talks in April, which produced a temporary ceasefire but collapsed after 21 hours of negotiations on a more permanent framework. Iran refuses to make the nuclear concessions that American negotiators are demanding, specifically the moratorium on uranium enrichment that the U.S. has identified as a non-negotiable red line. The Strait of Hormuz remains restricted by Iranian naval positioning. Oil prices recover toward $110 per barrel or higher as the market reprices the war risk premium that briefly collapsed on today's peace deal hopes. The Federal Reserve remains trapped, unable to cut rates into re-accelerating energy inflation. And the Bitcoin market, which moved from $62,000 in April to $82,000 today, a move of approximately 32% driven substantially by short covering, derivatives momentum, and peace deal optimism, faces a structural reversal when the buyers who entered on today's headline find no fundamental confirmation to hold their positions. This scenario has a specific mechanical danger that is different from ordinary market corrections. The perpetual futures market currently has elevated long positioning following the squeeze of the past few weeks. If the deal collapses and Bitcoin falls sharply, those leveraged longs face liquidation, and a liquidation cascade among longs is the mirror image of the short squeeze that drove the price up. Long liquidations force selling, which drives the price lower, which triggers more long liquidations, which creates more forced selling. The compressed stablecoin reserve base, currently at $66.37 billion, its lowest level in months, means there is limited dry powder available on exchanges to absorb that forced selling and arrest the decline at a support level. The combination of leveraged longs at risk, thin stablecoin reserves, and no confirmed spot demand underneath the current price creates conditions for a sharp retracement that could be disproportionate to the scale of any individual headline. The indicators that signal scenario 2 before the price confirms it are 4. First, oil prices recovering above $100 per barrel after today's drop. A sustained hold above that level for more than 2 consecutive days would signal the market is repricing the durability of the peace deal. Second, Iranian public statements explicitly rejecting the nuclear terms described in the Axios MOU report, particularly any language from Iranian Supreme Leader Khamenei or Foreign Minister Araghchi that challenges the moratorium terms. Third, stablecoin exchange reserves accelerating their outflow below $60 billion, signaling that capital is continuing to leave the ecosystem rather than rotating back in at current price levels. Fourth, perpetual futures funding rates turning sharply positive, above 0.03% per 8-hour period, signaling that the derivatives market has flipped to an overcrowded long position, which historically precedes sharp corrections as that positioning unwinds. Scenario 3, the sovereign black swan. This is the scenario that carries the highest potential price impact and the lowest current probability weighting from the market, which is precisely why it deserves the most careful attention. Markets are priced most attractively when their most powerful potential catalysts are least anticipated. Patrick Witt said at the Las Vegas conference 10 days ago that the White House would make a big announcement on the strategic Bitcoin reserve in the next few weeks. That timeline, if taken at face value, means the announcement could come during the same 30-day window in which the Iran-US peace negotiations are supposed to reach their conclusion. The simultaneity of these two potential catalysts, a formal peace deal that removes the oil-driven monetary suppression of Bitcoin, combined with a formal U.S. government announcement that clarifies and accelerates the operational structure of the strategic Bitcoin reserve, would create a demand event with no historical precedent in this asset's existence. Consider the arithmetic of simultaneous catalysts. The peace deal alone, if confirmed and durable, would remove the Federal Reserve's constraint on rate cuts, reduce energy inflation globally, and restore the pre-war monetary environment in which Bitcoin was trading at or above $97,000. That is one catalyst. The Strategic Reserve announcement, if it clarifies a mechanism for active accumulation beyond merely holding seized coins, would introduce sovereign demand from the world's largest economy into a market where the daily new supply is 925 Bitcoin, and the currently circulating float is already at a 7-year low of 2.21 million Bitcoin on exchanges. That is a second catalyst. If both materialize within the same 30-day window while the exchange-held Bitcoin supply is at its lowest since 2017, the supply-demand mechanics become equations that no precedent can calibrate. The specific on-chain indicator that would signal the sovereign black swan scenario before any official announcement confirms it is precise and unique. If Bitcoin begins moving out of wallets definitively associated with the U.S. Marshal Service, the federal agency that currently custodies the government's seized cryptocurrency holdings, toward new Treasury Department-controlled addresses, that on-chain movement would be the most reliable leading indicator of imminent formal reserve consolidation available. Glassnode and Arkham Intelligence track these wallet clusters with known attribution. Any movement of significant scale from USMS-associated wallets would be visible on-chain within minutes of the transaction confirming. That signal, if it appears, would represent a moment where the engineering of markets and the engineering of geopolitics converge in a single data point. Until that movement appears, the sovereign black swan remains the most powerful scenario in the analysis, and the least confirmed. At the beginning of this video, I told you that most analysts were reading today's event completely backwards. Now you have the full picture, and you can see precisely why. Read at the surface, oil falling 6% and Bitcoin rising to $82,000 looks simple. Peace is good for risk assets. Less geopolitical tension means lower inflation risk. Lower inflation risk means the Federal Reserve can cut rates, and rate cuts are good for Bitcoin. All of that is directionally correct as a chain of logic. But the engineering of what actually happened in the order book and on-chain today tells a more complicated and more honest story. The rally to $82,000 was real in terms of price, but it was built on a derivatives structure that had been accumulating 46 days of negative funding. A crowded short position that had been waiting for exactly the kind of headline catalyst that the Axios report provided. The short squeeze that resulted from that catalyst was real. The $4 billion contraction in stablecoin exchange reserves over the past week tells you that the new money that should be funding a genuine structural rally has not arrived yet. The crypto quant apparent demand data tells you that spot accumulation was negative throughout the April rally that preceded today's move. Those two data sets together tell you that $82,000 is a level that was reached through the ceiling of speculative pressure, not built up through the floor of genuine accumulation. That does not mean the rally is over or that Bitcoin cannot hold this level. What it means is that the next 48 hours of on-chain and macro data carry more informational weight than any equivalent period in the past 2 months, because that window will tell you whether the peace deal catalyst is large enough to bring the real spot demand that the rally has not yet attracted. If the stablecoins start replenishing, if apparent demand turns positive, if ETF inflows accelerate, the structural case builds. If oil recovers, if the Iranian side rejects the nuclear terms, if stablecoin reserves continue falling, the structural fragility wins. There's a longer arc to this analysis that the short-term data cannot fully capture, and it is important to state it clearly, even in the context of all the uncertainty we have discussed today. The structural backdrop of this market has been permanently altered by two forces that did not exist in any previous Bitcoin cycle, and that will not disappear regardless of what happens with the Iran negotiations in the next 30 days. The first force is the presence of spot ETFs managing over $100 billion in assets, with BlackRock alone holding nearly 7% of all Bitcoin supply in a single regulated product that continues to attract institutional capital at a rate that has no precedent in ETF history. The second force is the active geopolitical competition for Bitcoin as a sovereign reserve asset, with the United States government holding 328,000 Bitcoin in legislation pending that would authorize the purchase of 1 million more. These forces have permanently compressed the available float of Bitcoin. Exchange reserves at a 7-year low of 2.21 million Bitcoin. Long-term holders controlling 78.3% of circulating supply. Whale wallets executing their largest 30-day net accumulation since 2013. That structural picture does not change because of one news cycle, regardless of its direction. The mathematics of 21 million Bitcoin is not a narrative that institutions invented to justify their purchases. It is not a talking point from a conference stage. It is a protocol statement, fixed, immutable, encoded in the most distributed and battle-tested computer network ever built, and indifferent to the opinions of analysts, central banks, governments, or market participants of any size. Every sovereign government that accumulates Bitcoin, every ETF that absorbs coins from the exchange float, every long-term holder who moves their Bitcoin off an exchange and into a hardware wallet and cold storage, each one of them permanently tightens the supply available for the next buyer. And the identity of the next marginal buyer in this market may be changing in ways that the pricing models of traditional finance are not yet equipped to handle. The next buyer in line may not be a retail trader sitting at a laptop in Sao Paulo or Tokyo or Lagos. The next buyer in line may be the United States Treasury, competing in the spot market with BlackRock and Fidelity and Morgan Stanley for ownership of the same 21 million coins that Satoshi Nakamoto decided in 2009 was the correct number for a monetary system that no single person, no single institution, and no single government could ever inflate away. Monitor the stablecoins. Monitor the Iran deal. Monitor the on-chain wallet movements of U.S. government addresses. Those three data streams will tell you, before the price does, before the headlines do, before any analyst has time to process and publish their interpretation, which of the three scenarios described in this video is materializing in real time. That is the edge that engineering gives you over narratives. That is why this channel exists. If you want to be in the room when the next signal appears, subscribe, activate the bell notification, and we will reach you when it matters. This is Engineered Markets. See you in the next one.